Welcome to the 2016 Contribution Limits and Current Tax Law section. We update this section every year so that you will always know the applicable limits for your exam. There are very few changes for 2016 over 2015. We can thank the lack of inflation in our economy for that. There are a lot of numbers to know here, so make sure that you practice. Let's get started. We need to know the limits for qualified plans, and we need to know who is eligible to make what they call a catch-up contribution. So I was teaching a class and somebody had asked me, so are you telling me that that's all I can put in to an IRA? Was the question. And I said, well, yeah. And she said, I had no idea. So it is important to realize that when we're talking about qualified plans, whether or not it's an IRA or a 401k, how much you can put in any given year is there's a limit, right? That's set by tax law. And the contribution limits vary depending upon your age. So very oftentimes the test likes to ask questions about things that don't change over time because they don't like to update the test all the time. So catch-up contributions, which we'll talk about depending upon the qualified plan, there are different amounts, but the catch-up contribution itself, who is it available for? You should definitely know this. A person that is 50 years of age or older. So this is always a test question. Who is eligible to make catch-up contributions? So we'll start off with a limit for a traditional 401k or a safe harbor 401k plan. So there's different limits depending upon who we're talking about. Obviously, depending upon what kind of plan we're talking about. So we start off talking about how much can the employee defer. This is a pre-tax contribution. So for 2016, the pre-tax contribution amount is at most what you earned, or $18,000, whichever of those is less. Whichever of those is less. So you can, as an employee, in pre-tax dollars, contribute $18,000 into a 401k plan. Now, if you are age 50 or older, the catch-up for the 401k, and we're going to see actually these limits come back to quite a few different plans, is $6,000. So if the question says, Stan, who's age 54, can contribute how much to his 401k, you would answer $24,000. So that would be the limit for 2016. The employer match is entirely voluntary. So whether or not the employer contributes or not is up to the employer, and it does not count towards the limit. So the 18, the 6,000, if you are 50 years of age or older, that is for the employee only. The maximum employee-employer contribution cannot exceed the lesser of $53,000 or 100% of compensation, or $59,000 if you're 50 years of age or older. So there's no amount that the employer must put in the match. If there is a match, it's entirely voluntary. The maximum considered compensation when determining employer and employee contributions is $265,000. So you might be thinking, that's a lot of numbers, Susie. What is it I really need to know? I would definitely know these. For sure. And of course, you already know that it's pre-tax dollars that go in. Some employers that have a 401k will allow you to choose for the employee contributions to put the money into a Roth 401k. The Roth 401k would be after tax dollars. The same limits would apply to the employee deferrals into a Roth 401k. So 18, 6,000 would be the catch-up. So same. There's also a solo 401k, which is for the self-employed that have no employees other than their spouse. It has the 18,000 employee contribution limit, the 6,000 catch-up. So I did tell you these are going to be numbers that we see over and over for 2016. The employer, if you have a solo 401k, you're self-employed. So the business, the employer contributions that can be made, if the business itself is an S Corp, C Corp, or LLC taxed as a corporation, cannot exceed 25% of compensation. The profit-sharing employer contributions, if the business is a sole proprietorship, partnership, or LLC taxed as a sole proprietorship, is 20% of net adjusted business profit. We have the same maximum employer-employee contribution, the lesser of $53,000 or 100% of compensation, and the same maximum considered compensation of $265. The SEP IRA, so Simplified Employee Pension Plan, is for a small business, no more than 50 employees. The SEP funded by employer contributions only. Employer contribution limit for a SEP. So the 401k for a large business, granted the solo 401k, not necessarily a large business. The SEP IRA employer limits for 2016, 25% of the employees' earned income or $53,000, whichever is less. Which is the same as what we saw with the solo 401k. So SEP IRA, self-employed. Self-employed. Small businesses as well. So you can do it as a small business if you have up to 50 employees. So solo 401k could be for a small business, the self-employed, SEPs, and even KEOs. So there's actually different plans depending upon the needs of the business that they can choose from. The SEP IRA has the strictest eligibility requirements. So what that means is that this is the worst the business could set it up for as far as who's eligible. The business can always, any of these requirements can always be better than the requirements set by law. So the strictest a SEP could have is age 21 or older. Employees would be covered if they're 21 years of age or older, and they've worked for the employer for 3 of the last 5 years, and they've received at least $600 in compensation from the employer for the year. When you have a SEP IRA, contributions do not have to be made by the employer every year. So if you had a business in the recession, you did not have to contribute to the SEP IRA if that was your plan during that period of time. But if there is a contribution made in a given year, they have to make the same contribution available to all of the eligible employees. Of course, because qualified plans are non-discriminatory, you can't set it up to be better for others. Best for the owners, worse for the workers. You can't do that. That's, of course, against ERISA requirements. So SEP IRA, small businesses with up to 50. Now, some SEP IRAs permit non-SEP contributions, which are regular IRA contributions that can be made by the participant up to the maximum annual limit, which is the annual limit for the IRA. So the individual retirement account or individual retirement arrangement, depending upon what you're reading, same thing, for 2016 is $5,500. So some SEPs allow non-SEP contributions, which means they allow the employee to put their IRA contribution into the SEP as well, up to the limit. If you do that, if you make the non-SEP contribution as the employee, that reduces your eligibility. You can't have an IRA and make a non-SEP IRA contribution. You can do, I suppose you could split it. That never makes any sense to me. But you can't do both. You can't do both. Catch-up contributions are allowed if you are age 50 or older, yes. The additional amount into the IRA or the non-SEP IRA employee, if it allows it, which remember it doesn't have to allow it, if they allow it, is an additional $1,000 for a total of $6,500 for IRA contributions for those that are 50 or older. The maximum considered compensation, once again, stays at $265. So SEP IRAs, we have the small business, self-employed, no more than 50. Simples, we go up to 100. So simple plans, simpler to administer than the 401k. So up to 100 employees. Simple stands for Savings Incentive Match Plan for employees. The strictest the eligibility requirements can be for a simple. So these are very unique. An employee that has received at least $5,000 in compensation from the employer in any 2 preceding calendar years, whether or not consecutive, doesn't matter, and who is reasonably expected to receive at least $5,000 in compensation this year. So it has nothing to do with age. It has nothing to do with years of service per se, granted the $5,000 in compensation in any 2 preceding years and reasonably expected to be so this year. That's as strict as it can be. Companies can always make it easier than that. With a simple IRA, it allows the employee to contribute up to, in 2016, $12,500 of their salary. It's a pre-tax contribution, of course. If you were age 50 or older, the catch-up contribution for the simple is half of what it was for the 401k, so it's only 3. So notice, these are different than the 18 and the 6. So simples have lower employee deferral limits. So if somebody was age 50 or older into their simple, they could put $15,500. So the employee can contribute what they earned up to the limit, whichever is less, and the employer can contribute. So with a simple, the employer has a choice of how they do it. They can either do a match or they can do what is called a non-elective contribution. So if they choose to do a match, if they do a match, it's 1 to 3%. It depends on what the employer chooses. So either a match of 1 to 3% or non-elective of 2. I'll explain what this means. So first we'll do the match. So let's say that the employee is putting in 1% and the employer would match 3%. Well, the employer is only going to put in 1% because they're only going to match. If the employee is putting in 5% and if the employee is putting in 5 and the employer would match up to 3, well, then the employer will put in 3. So the smartest thing to always do if you have a qualified plan is to put in enough into it to get the maximum that you can from your employer, which is a match. So never, my advice at least, would be never put in less than the match. It's free money, you're just leaving it on the table. So if the employee puts in nothing and the employer has it set up as a match of 1 to 3%, but the employee puts in nothing, then the employer puts in nothing. The non-elective deferral for the employer says, we don't care what the employee does. We don't care if they put in 0. We don't care if they put in 10%. We put in 2, which is, I don't know, it's kind of nice as far as that goes, because sometimes, you can't control your employees. And if they don't put in anything and you've done a 2% non-elective deferral, as far as the employer goes, you're always going to be contributing 2% of their salary into their simple account, no matter what they do. So it's up to the employer. They can change it every year as far as how they've set it up. The maximum considered compensation for non-elective contributions, just like always, is $265,000 for 2016. KEOs for the self-employed. So HR 10, you don't hear a lot about KEOs anymore, but every once in a while they'll appear on the test. So there's lots of choices as far as businesses go these days for what to do for qualified plans. The Keogh contribution limit is 100% of compensation or $53,000, whichever is less. So you're self-employed. If you have employees, which is a self-employed person, you certainly can. You have to put in the same for everybody. You can't be discriminatory, so you have to be fair. 100% or $53,000, whichever is less. The maximum deductible contribution amount is 25% of eligible compensation, and the maximum considered compensation for the Keogh is once again $265. A TSA is a qualified plan for public school employees. We sometimes hear it referred to by its internal revenue code, which is 403B, just like 401k is an internal revenue code. So tax sheltered annuities. So for public school employees and nonprofits, TSA. It's the only annuity funded with pre-tax dollars. It is funded by employee contributions. It has the same limits as we saw with the 401k. So for 2016, up to the employee elective deferral amount, $18,000, with a catch-up if you're 50 years of age or older of $6,000. The total limit on annual additions, which would be a combination of all employer contributions and employee deferrals. Now remember, in a TSA, the employer may or may not contribute, would be 100% of includable compensation or $53,000, whichever is less. The 457 plan is a qualified plan for government employees and employees of tax-exempt organizations. So some nonprofits will do 403Bs, some have 457 plans. They have the same amount as the 401k, the same amount as the TSA, $18,000, $6,000 additional for the catch-up contribution. So this also is true for the 457 plan. Now, with the 457 plan, they have something that's unique. It's called the pre-retirement catch-up limit, which is an additional $18,000. It allows the employee to make an additional contribution of that amount to make up for years in which the employee did not contribute the maximum that he or she was allowed to contribute under the current employer's 457 plan. So that really you could do the 18 plus another, I guess you'd have no paycheck, depends on how much you make, I know, plus another 18 into the 457 as far as being the employee. And if I was age 50 or older, I could do another 6. But that's only if I've under-contributed in previous years, which is very common. How many people actually contribute the maximum? Very, very few. I don't know a statistic, but none. Very, very few. So that's unique to the 457 plan. So the biggest red flag there, the one that you heard a lot about, is the $18,000, the 6 for the catch-up. Know that the symbol is unique, the symbol having the $12,500 contribution amount for the employee plus the catch-up that's half of the 6. So it's only 3. So those are the big ones for sure to know. What else do you need to know? IRAs. IRAs are always on the exam. IRAs. So once upon a time, all we had was the traditional IRA. Today we have the traditional IRA, or we have a Roth. The contribution amounts, the maximums, are the same. No matter which one you're contributing to, you can't do both. I suppose you could split it, but like I said before, that never makes any sense to me. Why would you do that? So the contribution amount for 2016, $5,500, and the catch-up is $1,000. So depending upon your age, you could contribute, if you're 50 years of age or older, $6,500. That's for this year, so 2016. So this is always something that I want to make sure makes sense. You guys probably get it, but I don't know that everybody out there walking around the world understands how this works. So every year, the IRA contribution can be made up to the limit or whatever you earned, whichever is less. You do have to have earned income to have an IRA, of course. So if you only earn $2,000, you can only put in $2,000. So I went to work, I had a paycheck, earnings, not investment return, not dividends or capital gains or interest, not that. That's unearned income. So we're talking you have a job. So how much you could contribute in 2000 was a function of what was the contribution limit in 2000, which I can't remember off the top of my head, but I was teaching the class at the time. Or whatever you earned, whichever was less. And then in every additional year, you can contribute again. So this is outside of what you do at work. So common test question, can you have a TSA and an IRA? Yes. A 401k and an IRA? Absolutely. You could even have a 401k and then be self-employed and have, let's say, a KEO and an IRA. You could, if you had 1099 income, you could use that to do the KEO, your 401k and an IRA. So the limit changes, well, has the potential, I should say, to change every year. And that's how much you can put in. And you can put it in up until the tax due date of the current year's taxes. So really, you can contribute to 2016 all the way through April 15th of 2017, the contribution amount for the IRA. So of course, because we do in the general portion of the class, a big discussion on which one is potentially tax-free dollars earnings or tax-free, which one has tax-free earnings, if I can talk. That's the Roth, always funded with after-tax dollars. The traditional IRA, the money may or may not be tax deductible, which we'll talk just a little bit about. So the absolute number one thing you must know as far as this section of the course goes is what's the limit for 2016. This is one of those that they do like for you to know for your exam. So $5,500, $6,500 if you're 50 years of age or older. With a traditional IRA, is it always tax deductible? No. So what makes it tax deductible is it's a two-step rule. So let's talk a little bit more about this. So traditional IRAs, the contribution that you make, in one regard, you can think of it like this. You're always putting in after-tax dollars. But you may get a tax deduction when you do your income tax return, which would have the effect of making it a zero cost basis, thus making it pre-tax dollars. So traditional IRA contributions may or may not be tax deductible. They may or may not be tax deductible. Where the Roth IRA contributions are never tax deductible. Never. It's always after-tax dollars that go in. So what is the rule? How do we know? Number one, do you have a qualified plan at work? Do you have a qualified plan at work? So they'll sometimes use this term active participant, which basically means could you enroll in a qualified plan where you work? If the answer to that question is yes, okay, if yes, then we look at income, which I'll explain. If no, then the contribution amount is tax deductible. Now, that doesn't mean that that's what you fund. You can still potentially fund a Roth IRA. Granted, if you earn too much, you can't fund a Roth IRA, and I'll talk about that in a minute. So if you have a qualified plan at work, that's when the second step, as far as what is your modified adjusted gross income, which is a line on your tax return, don't ask me which number because it does depend on what form you file. So based upon your modified adjusted gross income, which we sometimes call MAGI, you may be allowed a full deduction, which means a zero cost basis, a partial deduction, or no deduction at all. But the number one thing you look at is, do you have a qualified plan where you work? If you do not, then we don't care about the income level at all. Okay? So when you're single head of household, it says modified adjusted gross income for 2016, $61,000 or less. Then you're allowed a full deduction. If your modified adjusted gross income is $61,000 to $71,000, then it's a partial deduction. It phases out. The more you make, the less deduction you get. If your modified adjusted gross income is $71,000 or more, then there is no deduction allowed. So $61,000 or less, fully deductible. Over 61 up to 71, partial. Over 71, well, 71 or over, then no deduction at all. Honestly, I don't think those numbers are going to play into your test. I really don't. They do change every year. And from the point of view of writing a test, who wants to deal with something that changes all the time? Where something like the IRA contribution amounts, absolutely you ought to know that. But this idea of if you have a qualified plan at work, can you still claim a tax deduction? The concept of it being based on your modified adjusted gross income, yes, that I would like you to know. I'm not so much worried about the 61 to 71 numbers. It'll help you for the section quiz, however. Now, so those were the numbers for single head of household, depending upon your filing status, being single or head of household. If you're married, filing jointly, or a qualified widower or widower, then the modified adjusted gross income is higher. So $98,000 or less, you're allowed a full deduction. If it's over 98 but less than $118,000, then you have a partial deduction. If you have a modified adjusted gross income of $118,000 or more, then there is no deduction allowed. Married filing separately. The IRS doesn't like when people do that. There used to be reasons why people did that to get rid of the marriage tax penalty. The marriage tax penalty itself is not as bad today as it used to be historically, so not as many people do married filing separately today. But when that is the case, if you have a modified adjusted gross income less than $10,000, they'll allow a partial deduction. $10,000 or more, no deduction at all. If you file your taxes separately and did not live with your spouse at any time during the year, your IRA deduction is determined under the single filing status, which is different from married filing separately. Now, I said if you are not covered, let me rephrase, if you are not covered by a qualified plan at work, then you can always claim a deduction, and that's a slight simplification. They will look at, is your spouse covered at work? So if you're not covered by a qualified plan where you work, the deduction is only limited if your spouse is covered by a qualified plan where they work. And only depending upon your tax filing status. So if you're single head of household, qualifying widower or widower, well, then the whole idea of having a spouse doesn't really work, right? So the modified adjusted gross income of any amount, you're allowed a full deduction. You don't have a qualified plan where you work. If you're married filing jointly or separately with a spouse that is not covered by a plan at work, once again, you can earn modified adjusted gross income as high as you like. It doesn't affect your ability to claim a tax deduction. It's when you're married filing jointly and your spouse is covered at work that we're going to start to see a phase out. So if the modified adjusted gross income is up to $184,000, you're allowed a full deduction up to the amount of your contribution limit. If it's more than $184,000 but less than $194,000, it's a partial deduction. Modified adjusted gross income of $194,000 or more, then no deduction is allowed. If you're married filing separately with a spouse that is covered by a qualified plan at work, it's the same rule as when you had a qualified plan. So modified adjusted gross income less than $10,000 allows a partial deduction, $10,000 or more, no deduction at all. So it is, the simplest rule is to say if you don't have a qualified plan at work, you get to claim a deduction for what you contribute to a traditional IRA. It is true if you're married and you file a joint return, which is most common when you're married, and your spouse is covered, then there is a phase out. It occurs between 184 and 194 in 2016. How much can you put into traditional? Depends on your age. You're 60. You can put in $6,500. You're 30, $5,500. Know that. Roth IRA, same limits, like I said before. The Roth IRA is always an interesting one, I think. It's very popular because the earnings, of course, are federally income tax free if it's a qualified distribution. So the account's been open for a minimum of 5 years, paid out on or after 59 and a half, or there's other reasons why they'll allow it to be a qualified distribution: death, disability, divorce, things that we cover in the general section. But not everybody can contribute directly to a Roth. It does have an income phase out. So the Roth IRA does have a cap on what you can earn and contribute. So it has a phase out. Now, the way around the phase out is the back door, which always cracks me up and means, to me at least, that they should take off the phase out. But it's the only reason why I'd ever run for any sort of elected position, to get rid of the income limitation on a Roth. Because in reality, when you earn too much, you put it after tax contribution into a traditional IRA, and then you can roll it into a Roth no matter what. So, oh well. You should know not everyone can contribute to a Roth. First off, you have to have earned income. Second off, not too much. Now, you can be any age. So you could be a greeter at Walmart, you're 70 and still contribute to a Roth, so that's nice. You're 76 and you're still working. You can still contribute to a Roth IRA, where you can't do that into a traditional. You must begin contributions. There's a time limit on that, right? So what is the phase out? So it depends on the year, and it depends upon your filing status. So for the Roth IRA, if you're single, head of household, or married filing separately, you did not live with your spouse at any time during the year. If you had a modified adjusted gross income of less than $117,000, you can contribute up to the limit. $117,000 but less than $132,000, how much you can contribute is reduced. A modified adjusted gross income of $132,000 or more, you cannot directly contribute to a Roth IRA. If you're married filing jointly, or you're a qualifying widow or widower, the amount is higher. Modified adjusted gross income of less than $184,000 in 2016 allows you to contribute up to the maximum. $184,000 to $194,000, that's where the phase out occurs. Modified adjusted gross income of $194,000 or more, you cannot contribute directly for 2016 into a Roth IRA. Married filing separately, and you lived with your spouse at any time during the year, we have the same amount that we had with the traditional. So modified adjusted gross income is 0. You can contribute up to the limit. Modified adjusted gross income is more than 0 but less than 10. So there's the 10. That's what I was referring to being the same. The amount you can contribute is reduced. Modified adjusted gross income is $10,000 or more. You cannot contribute. So same thing with the traditional. $10,000 or more, you cannot contribute if you're married filing separately and lived with your spouse during the year at any point. The conversion limit. So the conversion from a traditional into a Roth, this idea of rolling the balance over, is allowed no matter what your adjusted gross income is. Although if there's a balance in your traditional IRA that has not yet been taxed, when you roll it over, you will be creating a taxable event, because the Roth is after-tax dollars and the traditional very oftentimes was a pre-tax contribution. So anything you roll, so let's say you put in $5,000 into your traditional IRA and you rolled it into the Roth. Whatever's in there, there's a zero cost basis in my example. Whatever you roll is taxed in the year of the rollover. So the rollovers don't affect your current year's contribution limit. They just very oftentimes create a taxable event. So you do need to be aware of the tax consequences of the rollover. And that is the back door. And it is a lot of paperwork if you put it into traditional and want to roll it over the next day into the Roth, but you can. So it's always good to know that it's there. So those are our qualified plan limits. Exactly how many questions you have really depends on your test. So I do expect you to practice so that you know them. And then, if you have very few questions, sorry, I made you learn something that wasn't huge on your test, but someone else taking the same exact test as you might have more questions. It really is just the luck of the draw. I'm never quite sure how many you'll get.